Hello and welcome to Quilter Cheviot's Markets Uncut podcast, your weekly insight into the topics and trends that we've been exploring for you here at Quilter Cheviot. Remember, so you don't miss future episodes, be sure to hit the follow button on whichever streaming platform you're listening on, or by following hashtag QC Weekly Comment on LinkedIn. I'm your host, Chris Scott, investment manager based out of our Glasgow office, and this week I'm pleased to be joined by Ghaz Saleem, Fund Research Analyst, and Equity Research Analyst specialising in the financial sector, Will Howlett. Good morning to you both. Ghaz, starting with you, our listeners will be well aware that one of the main drivers to market volatility in 2025 has been Trump's tariffs. With the 90-day pause ending this week, can you summarise where we are with this from a market perspective? And furthermore, markets are currently higher than they were before Liberation Day. Where is the optimism being driven from?
Absolutely. Thanks very much, Chris. So we have only actually seen a small handful of deals announced by the Trump administration so far following the tariff pause, with further deals expected to be announced imminently. But negotiations in practice are slow and challenging, and it is unclear what will actually happen on the day of the deadline. In this backdrop, the S&P broke a new record last week and is now up more than 25% from its trough in April. This does feel counterintuitive, so why are markets so seemingly relaxed? Well, there are a number of factors at play here. First of all, Trump has earned a reputation for backing out of his most punitive threats. Markets have started to view his strategy as one of escalate to de-escalate. Trading counterparts have largely also tried to cooperate and avoid escalation as well. For example, Canada cancelled its digital services tax last week after Trump threatened to end negotiations. There's also a degree of expectation that the deadline will be moved forward to August the 1st, with, for example, Scott Bessent noting over the weekend that some countries would be able to negotiate a 3-week extension. From a top-down hard macro data perspective, we haven't yet seen any significant weakening in the US economy as a result of the tariffs. The ISM Services Index, for example, moved back into positive territory last week. Last week's employment data overall was also largely affirmative of continued resiliency in the labour market trends that we've seen in place for much of the past year. And equally, inflation data generally hasn't registered a meaningful impact from tariffs either. We've seen similar trends across Europe, and Europe has also had other drivers such as a forecast rise in defense spending supporting equities. From a bottom-up perspective, corporate earnings have also remained generally resilient, and mega-cap tech stocks and AI-linked companies have performed particularly well. Retail investors, on their behalf, have also been actively buying the dip, although institutional investors have been more cautious of US markets. So in terms of this week and what happens next, I do believe that some caution is required. It is still too early to clearly assess the impact of tariffs on inflation, on jobs and earnings, and so the premium valuation in the US does feel somewhat less compelling. We have no real idea of how things unfold on the 9th and beyond, and there could still be significant market jitters if we revert to a state of escalation. On that point, for example, Trump has said that he's going to start sending out letters to countries telling them unilaterally what their rates are going to be. And he's also threatened 10% additional tariffs on countries aligning themselves to the BRICS. Furthermore, non-dollar investors need to continually be mindful of further dollar weakness, which has had a significant impact on their returns from US investments so far. And then, of course, there are the broader market concerns, such as fiscal deficits. We saw an episode of that last week here in the UK. And then politics could also throw up unexpected headlines. So all in all, we could potentially see further support from equities, but equally we could see volatility jump again in the days ahead. So as always, it's sensible to stay balanced and diversified.
Thanks, Gaz. And one of the other geopolitical drivers to markets has been the unrest in the Middle East. Can you please provide us with an update of where we are here?
Certainly. So the situation in Gaza, to begin with, remains complex, and it's unclear how this will resolve in 21 months into the conflict. Benjamin Netanyahu is due to visit Trump this week, so there are some hopes of another ceasefire being negotiated. But while the humanitarian impact of this war is obviously very concerning, And as far as markets are concerned, the direct impact on financial markets is very limited. It's really the war between Israel and Iran, which was viewed as more material, with oil prices and their potential knock-on impact on inflation being the main transition mechanisms into financial markets. Iran itself is a relatively modest share of global oil supply, but a broader escalation could have seen the Strait of Hormuz, for example, being blocked or regional oil facilities attacked, which could have been more impactful. In fact, following the US strikes on Iranian nuclear facilities, we did see a spike in the prices of crude oil. But the Iranian response to those attacks was largely seen as symbolic. So they chose not to go for some potentially more damaging options. And following that, geopolitical risk in the Middle East between Iran and Israel has seemingly settled after the 12-day war. In the near term, Iran and its proxies have been weakened, which could potentially pave the way for further peace deals. But in truth, the situation in the region remains a complex one. The future of Iran's nuclear capabilities is still unclear, and the president has recently suspended cooperation with the UN nuclear watchdog. Iran could also potentially double down on its missile manufacturing in the face of what it's experienced recently, or it could simply adopt a strategy of threatening more US assets in the region. Again, in terms of market impact, however, the Middle East contributes a low single-digit percentage to global GDP, and of the countries in that region, it's only two who are really in the MSCI emerging markets, and those two are relatively modest weights. So markets for now view the situation as contained and have largely settled in response.
Thanks, Gaz. Well, as our finance analyst, we have seen Mr. Trump pressure the Federal Reserve to cut interest rates in the States. We're also pricing in at least 2 cuts in the UK. Can you let the listeners know the impact this will have on your sector, particularly companies whose loan rates are linked to the central bank rates?
Morning, Chris. Yeah, so I think most relevant for the banks in the financial sector, and all things equal, you would expect lower interest rates to be a negative. So simplistically, when rates fall, banks can't earn as much on loans or securities, and so the net interest margin, that's the difference between what a bank earns on loans and what it pays on deposits, can come under pressure. But there are some offsets. So cheaper borrowing costs can boost lending activity. And so that means people are more likely to take out a loan at the margin. And so banks can grow their loan books, and that does help to mitigate some pressure on net interest margins. I think it's also really important to put the interest rate environment into context. So in the post-financial crisis environment, central banks pretty much floored interest rates around zero to try to stimulate economies, and inflation wasn't really a concern at that point. In contrast, over the last couple of years, interest rates obviously were hiked to over 5% for a time in response to the inflation that we saw post-COVID. So that has meant the banks with the strongest deposit franchises have been able to enjoy much wider deposit margins. So you can think of current accounts that you have with your bank, essentially earning nothing. Those can be invested pretty much risk-free for banks into the central banks and a very nice spread on those. That has all fed through to sector profitability, which is now much higher than in the post-GFC period. And I think that will still very much remain the case, even if rates come down a couple more times, particularly actually for the UK banks, which typically do more hedging. And so they're not actually yet seeing the full benefit of the rate rises that came through a few years back. I think banks generally quite like a stable outlook and a kind of Goldilocks. So interest rates not too high and not too low. So remember when rates shot up post-COVID, you saw those bank failures in the US, and there were concerns about deposit migration, both here and also in the US. Essentially, depositors looking to move money out of low or non-interest bearing accounts into higher rate deposits and into money market funds. And those issues really weighed on bank share prices through that time. So I think actually now a sort of slowly declining rate environment has been quite constructive for banks in the US and also in the UK and Europe. So yeah, we will wait to see if those rate cuts come through.
Thanks, Will. And on the topic of US banks, last week we saw the annual stress tests. As expected, all the major banks in the US passed. Can you tell us a bit more about this stress testing and what it means to the overall health of the banking market?
Yeah, so first off, what is a stress test? You can think of it like a fire drill for banks. So after the financial crisis, regulators wanted to make sure the largest too big to fail banks could survive another meltdown and keep lending to the economy. So you avoid that credit crunch type scenario that we saw with the GFC. So each year, the Fed imagines a worst case economic scenario. So it's a severe recession, a market crash, unemployment up to 10%, and sees if banks can have enough capital to withstand the losses that they would see in that environment. The banks each have to formulate, how much losses they see, and a check by the Fed. And if the banks stay above those minimum required capital levels, they effectively pass the test. It's quite easy to be cynical about the exercise, but the stress tests are really important in terms of setting capital requirements. So the stress tests help determine something called the stress capital buffer, which is effectively how much capital the banks burn through at the trough in the stress scenario, with a minimum of 2.5%. And so it's one of the factors that make up banks' minimum capital requirements. And so you can help, certainly it helps the banks think about how much capital they have in excess, and how much can be returned to shareholders. In terms of the results, they tested the 22 largest banks. They actually saw a smaller drawdown this year than last year. And a couple of reasons for that being bank profitability is stronger this year. So you can think of the benefit of higher rates more generally, as we just discussed. And then the fact that the scenarios were a little bit less strenuous this time round as well. You did see the banks then follow up with some dividend increases. So the likes of JP Morgan putting through a 7% increase on their dividend and also announcing a $50 billion buyback. Bank of America similarly increasing by 8%. So you saw the banks kind of being a bit more confident in terms of being able to return capital to shareholders on the back of these stress test results. I'd also just put it in the context of the Trump administration, which is generally looking to ease back on regulation, probably for the first time really since the financial crisis. So I think that's also framing why the banks have been a bit more confident to increase their payouts to shareholders.
Well, thank you both for those great insights, and to all of you for listening. We love to hear from our listeners, so please review the show now wherever you're listening, share it on your socials, and tag us at QuilterCheviot. To make sure you don't miss a future episode, tap the subscribe button. We'll be back next week, but in the meantime, head over to our website, www.quiltercheviot.com, where you can read the accompanying market overview as well as subscribe to our weekly comment newsletter. You can also stay up to date with our thoughts on market news, industry insights, and our upcoming events and webinars on our website or our social media pages. And that's it for today. So thank you, Ghaz and Will, for your time, and to all of you for listening. See you next time.